Good morning. I may have a little camera malfunction here. I'm gonna have to check on that. Dun, 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 dun. Let me see what's going on.
Can everybody hear me okay?
I can hear you fine, Brian.
Okay, great.
Yes, I can, and I'm having malfunctions too, so I'll just stay off camera.
Might just be the cameras, huh? I'm not trying.
My mic wasn't working for a minute there.
It's always fun, isn't it?
Oh,
It's always a good
absolutely.
time.
Yep.
Hmm. So my camera and mic are integrated. Are you guys hearing me?
I can hear you fine.
Huh. I wonder what I can't figure out what's going on with the mic. Hmm.
And the
Well,
camera, yeah, it even looks blurry. E-
yeah.
The
Let me see
picture of the
video.
camera. Your picture looks fine.
Yeah, picture. It's a really good looking picture.
It is a good looking
There we
picture. Oh,
go.
Oh, there you
here we
go.
Yeah,
go.
there we go.
Here we
Okay,
go.
that's better. Okay. Um, well, today we have Brian Wilbur with us. This is Denise Holiday. Brian, I never know how many people are going to show up for this meeting. I mentioned
Sure.
earlier today that it's sometimes we get a couple people kind of dribbling in a few minutes past the half hour. It's also the annual enrollment period for Medicare, which keeps everybody in our business very, very, very busy.
Yes, I can imagine so. Tell me a little bit about that. How's that changing this year? I know it changes every year, but is this a more natural year or is there a bunch of hoops?
There's it's largely the same as it was last year with a couple exceptions. There was some big legislation this year surrounding the Inflation Reduction Act that changed the total max out of pocket on prescription drug plans,
Okay.
and it reduced it down to $2,000, and um, it also created a payment plan so that people that do get into the don't that do get into that $2,000 range have a means uh, to make their drug costs more affordable by paying for it on a monthly basis.
I see.
So those are the two biggies. We still have to, for the most part, meet with people and make presentations more than 48 hours after we execute the scope of appointment. That's not true for walk-ins. One of the things that's unique this year is that we do have a retail location. We're set up in a kiosk in one of the Walmarts here in the local in down in Parker. And
Okay.
other than that, not a whole lot has changed. There's a lot more plans in the marketplace than there has been in the past. I was
Okay.
doing a presentation earlier this morning for somebody, and there's so many plans it can be a little overwhelming sometimes just going through all the different options people have.
Yes. Yeah, I was gonna say, is more options always a good thing,
Yeah, I don't know if more is always better.
right?
You know,
No, it's not.
it's not. It's not. Yeah,
It's better.
we have to. So every year, Brian, we have to take the AHIP training course, which is a Medicare kind of fundamental foundational information training course.
Mhm.
And so we take that every year. It's about 6 to 8 hours of study time. And then every carrier, every insurance company has their own certification process for
Okay.
their products. And some of it's kind of redundant with the main course we take. But so you get five, six, seven, eight different certifications you got to get. It's easily 40 to 50 hours a year in recertification. So with that said, we've got some people that have invested some time in joining us today. So I'm gonna
Okay.
kind of get ready to turn things over to you too. So I was at a National Association of Insurance and Financial Advisors meeting at Cherry Hills Country Club within the last couple of months and met Brian and Holly, right?
That's correct.
Yeah,
Yeah.
Brian and Holly. They're a husband and wife duo, power couple
That's right.
in the mortgage financing industry, and I was impressed by them and kind of how they approach the business. And I said, you know what we ought to do is have you present kind of what's unique about what you guys do to dispel any kind of misunderstandings about what you do, and kind of spread the word about Bingo, not the game, but the mortgage company, and also kind of get that information in front of our agents and brokers who are out in front of people all the time and looking for new ways to help our clients, looking for ways uh, to understand their financial situation better. That opens some additional doors for us. But anyway, I'm gonna do this. I'm gonna turn it over to Brian because we're at about 36 minutes after the hour here, and I want to be respectful of your time during AEP.
Yeah.
So, Brian, the floor is yours. Do you want to share?
Yeah. Let me jump in. Well, first of all, thank you, David, for having us down here. You know, we did meet at that NAFA conference, and a big piece of what we do right now is education, and that's where the industry is right now, is as education. Everybody's doing their due diligence, so we're very involved at the lobbying as well as at the networking level for the at the advisor level. But what I want to do here is really make sure that you guys can walk away with some tactics. I'm a former active duty Marine, and so although there's an incredible amount of beauty and strategy, my goal is to make sure that you guys walk out of here really being able to make sure you can have a very elementary, intelligent conversation about this product. You're not going to be an expert in it in the next 45 minutes, nor am I going to be in yours. But let's start off real quick with a little bit of history of it. It's been around since 1961. Anything's been around that long has got a little bit of history, maybe even some mortgage, and or maybe some baggage, excuse me. And so what I mean by that is it's kind of evolved a lot like your cell phone has changed over the years. You remember your first cell phone back in the day? Big brick, right? Yeah. And now we look at these little computers that we have in our hands. They've gone through several iterations through the years. So what has happened is not only has the product become much safer for the consumer because there were some spooky things in the past, but it's also been accepted, for example, by FINRA. In 2017, FINRA changed their position after doing some research and looking at the models. It used to be a last course after you depleted the portfolio, all the other assets, that was the last resource. And now that position is rapidly shifting. Texas Tech, MIT, Cambridge University, they've all come to the same conclusion. Factoring in housing wealth into a retirement income plan almost always nets a better result, whether you do a reverse mortgage or not. So let me explain. I can go in depth about the history of the product and why it's safe and why it's different from how it used to be. That's actually some really good research everybody can do simply online. I find the most value that I can bring to the table is giving actual impact that we can make for clients. So help me understand a little bit, when you guys are going into retirement, what's the number one thing you guys are concerned about with regards to retirement income planning? What's your number one concern?
Will my income last?
Managing longevity risk, right? And so when I talk to our team, we're about a 9-man boutique team here in Parker, and all we do is reverse, and we're explaining how there's about 42 different tax strategies about how you can intelligently use strategic withdrawals from a reverse mortgage as an overall strategy to preserve the portfolio. Okay. And one of the things I want to throw out there is a little bit of a teaser, because you do need to do your own due diligence out there. The good news is it's easy to find the info, but the growing line of credit. All right. I'm not sure how many of you are actually aware of that, but the growing line of credit component on the reverse mortgage is the secret sauce. It is what's going to be mainstream in 36 months. It's what's going to be mainstream for all of everyone in your industry within the next 5 years from a fiduciary standpoint, because of the impact it can make long term. So let's talk a little bit about it. It's growing. It's a line of credit. There is no other one that exists. the caveat everybody needs to keep in mind and the framing that helps you guys evaluate who this would benefit and who it wouldn't, because it's not for everyone, is the tax-free component. This is a growing pool of tax-free income. So whether you're using it to pay the taxes in a Roth conversion, we all understand and everybody knows the best way to pay for a Roth conversion, right, is with tax-free money. Anytime you can pay taxes with tax-free money, that's a win-win. So there's a lot of techniques, there's a lot of strategy to it. It's very simple, but it's not easy to understand. Does that make sense? Yeah. So what questions do you have for me? How can I help make the most of your time when you guys think of reverse mortgages and how they may or may not apply? I mean, I have clients that I have partners that say a reverse mortgage would never work for any of my clients. I would never advise a reverse mortgage. And that's shifted over the last 5 years. Where are you guys at? Where are you guys sitting on this issue now?
Brian, I'm gonna jump in there because certainly you bring up a good point. I mean, 5 years ago, I had a very different feeling about these products until I began to understand how they work. The one of the questions I have is, it used to, 10 years ago, if you took out a mortgage and interest rates drop, you could refinance your mortgage. Well, the same true on the HECM side, which is a home equity conversion mortgage, is my understanding. On the HECM side, can somebody who took out, because I've got clients that have these things in Colorado, and then 5 years later, they've got this much more equity in their home, and they feel like that's not accessible because they go back to their original lender and they're like, yeah, no, this is kind of chiseled in stone.
Well, there's a twofold answer to that. One is from a business perspective with the lender, and I think you guys should be aware of this. And then there's also the reality of what options are available for the client. So typically, you're not going to see any refinance value within the first 3 years, right? And if your client's going to move within 3 years, that's also a threshold that our team is designed to catch and make sure that you're not paying for the closing costs. What I mean by that is within 5 years, we're not Missouri. We are blessed in Colorado to have home appreciation. We've all know what's gone up the last 15 years. And when we do build out our amortizations that go out 99 years, we factor that in because that's a significant piece. So to answer your question more specifically, yes, they can refinance. Yes, they can pull more equity out. And yes, there's an even smarter way of doing this, and it's by having the line of credit simply open and available, because what a lot of people just don't understand is not only is it tax-free, but every dollar you put in is immediately available again in the line of credit. So every time you make a payment, if you choose to, and there's strategies where you do that, that money is immediately available on that line of credit again. If your home value goes up and the equity goes up, you could simply pull more money out through a refinance like any other mortgage. Or you may be able to just simply access the line of credit and not have to refinance. There's some strategy there, but here's what really helps. Whether it's the 3-hour CE courses I teach for real estate agents, or if it's speaking with professionals like yourself, this has seemed to help. It's just a mortgage. It's just a mortgage. A dear colleague of mine, I learned this from him. Make it simple, all right? With a traditional mortgage, you pay a payment. With a reverse mortgage, it's paying you. Okay, but all the same rules apply. We got to pay taxes. We got to maintain the home. Okay, to FHA standards, very simple. All right, it's got to be your primary residence. Okay, and you got to pay those HOA fees. Okay, but if you maintain those things, this not only sets up a housing long-term solution, which gives peace of mind, but also from a cash flow perspective, this is a buffer asset, folks. That's what this is. This is a tool you turn on and you don't access it unless you need to. In the down years when your portfolio's not performing, don't choke the horse you're riding. Don't draw out of your portfolio. We all understand this, right? But what we don't understand yet and what's coming down the pike is how do we use the housing wealth as a buffer? How do we draw a little tax-free income to offset that and then repay it back even in the long term, or not? Or not. There's strategies where the line of credit is the primary value. But again, it's a buffer asset. So the product's been around for a long time. It's very safe. They've made some changes since 2017, so the spouses are safe. There were, prior to 2017, I would not be in this industry. I didn't wake up one day and say, hey, mom, I want to be in the reverse mortgage space when I get out.
Yeah.
I saw how this was impacting people. And with the way people are underprepared for retirement, this is going to be a lifeline. For those that are more affluent and understand how to wield these tools with a skilled professional, all right, and understand how to use this to lower the sequence of withdrawal risk, right? Understand how to offset taxes. We all know it's all about taxes, right? How about make this money go work for you? And by the way, there's no payment required. So with my real estate agents, and I've been talking a lot, David, so let me know, but I feel like this might be some things that are valuable. I often ask, the question we need to be asking our clients that are in retirement years is if your mortgage payment was voluntary, would that be something you'd want to know more about? And how would that impact your income? For some people, a cash flow tax-free of $1,000 a month, it's not going to change their tax bracket. It might be some side benefit. Maybe they can go take that and go make some more money with it, right? For some people, that's the grease, right, in the gearbox to make the retirement work. So,
Lisa, do you have a question? I saw you unmuted a couple times.
Yeah, no, I just had a comment because I used to feel the same way about reverse mortgage, that it was kind of sketchy, and I'd like to hear more about the how the spouses are protective. I'm assuming from the assets or whatever, maybe in a spend down mode. But my boyfriend just not only did he had to sell a place in California, moved to Colorado. He immediately reversed his mortgage, and then he just convinced his parents, who are 86 in Palm Desert, to do it to help them maintain home care. So that's how they're using it. And I'm really glad he did, because, they were thinking, oh, we want to leave this asset, to you, our kids. And like, these are grown kids in their 60s. They really don't need the house in Palm Desert. I mean, the income is great, but he convinced them, it's better for your health, to use that money now to help maintain, the amount of health you can. Now we just have to get them to actually use it to maintain their health, but that's a whole nother story. But anyway, just wanted to tell that story that, I've had two great examples of that recently.
Yes. Thank you. It means a lot to hear that. I think the word's getting out, I think this is a very interesting space to be in, because if you understand how to wield this product for your clients, you're going to differentiate not only from everyone else, but they're going to tell everybody about this because of the impact it can make. We've had people with tax liens, ongoing monthly payments with businesses that folded during COVID, and they've got this mortgage payment plus this tax lien from a business that folded, no income. They're burning through everything they have. And they'll meet one of us and have a quick conversation. We just give them facts. It's not a transaction. This is a process of doing due diligence. It's a kitchen table with the kids type of situation. Advisors are often there. Sometimes there's other estate attorneys, but it's a holistic view. How does this solve a problem, hedge against some sort of a risk, or create some of a type of benefit? And if it doesn't meet those criteria, this doesn't make sense. So protections, let me talk real quick. I'm not sure how many of you are aware, but everyone that goes through the reverse mortgage process, right, has to go through HUD counseling, housing and urban development, all right? And I joke in my class, it's an hour and a half on the phone with a federal agent, right? But there's no other industry that's more highly regulated than our space, and I'm very proud of that. Number one, after 2008, you look at all the mortgage regulations that came into play. We weren't in that space during that time, and I've heard some stories that are just absolutely wild. You could fog a mirror at 80 and pull 80% of your equity out and immediately go take it and have access to it. So you can only access about 43% of your overall equity, okay? Non-borrowing spouse protection, okay? What they found out was some people were presenting reverse mortgages that are largely based on age, interest rate, right? They're not largely based, they're based off the age, they're based off the equity, and they're based off the interest rate. So prior to 2009 or so, there were some people that got hurt because they only put one person on the note. And when that person passed away, the bank headline or the newspaper headline read, big bad bank, right, kicks grandma out of home for reverse mortgage. So the government stepped in immediately. And what didn't hit the news is a lot of those situations were resolved. But they also changed the laws that said non-borrowing spouses, okay, they have to be on the note no matter what, and it always has to go by the youngest borrower's age, okay? Does two things. Again, protects more equity, but it also provides protection that no matter how old the non-borrowing spouse is, could be several decades younger, they have the right and all the benefit that the other borrower has. So they could stay in that home for the rest of their life with no mortgage payment, and they also have access to the equity. All right. Now there could be some caveats in there, but the long-term non-borrowing spouse protection is one of the biggest advantages that changed.
That's helpful.
Yes, absolutely. And when something bad happens, especially within this protected senior community, they share that like wildfire, right? And so what doesn't happen is the education on things that have changed. That's why I'm so humble and grateful to be here with you guys today. Are there any other questions? Does anybody have any other questions right now? Using this reverse mortgage for purchase, I just tuck it as a feather in your cap. If you have clients that are upsizing or downsizing, right? We know that 40% of seniors are actually upsizing. If they're looking to do that, but they have what we refer to as golden handcuffs, right? They've got a $800,000 home with $125,000 mortgage payment or mortgage balance, and they've got 3%. And you guys intelligently advise them that could be one of the most goofy mistakes you could make right now would be to let go of that rate. Well, the reality is for 60% of the purchase price of the new home, for 60% down, they could move in with no mortgage payment. And so when they understand that if they could move in and that mortgage payment was voluntary, now they want to move towards the kids, closer to grandkids, maybe buy an investment home, maybe do some different things, maybe free up more capital to put into their portfolio and take advantage of some moments that we all know are coming and are short-lived, right? So reverse for purchase is a big piece. Long-term healthcare. We all know how undersaved people are. And I believe, who was talking about their family member, I believe out in California, that they were paying for in-home healthcare. Is that correct?
We're trying to get them to do that. They're still in denial that they need it, but they do. So at least they got the reverse mortgage and now they have the cash to help them do that. Yeah.
Good. Yeah. Long-term healthcare seems to be one of the last buckets everybody looks at. And I'm sure you guys understand these stats, but let me lay something on you. If you're 62 today, okay, you can spend anywhere or plan to spend anywhere from $300,000 to $600,000 in out-of-pocket, non-covered medical expenses. That's a real number. And where are people coming up with this money? Right? People are living longer. If you're 62 right now and married, 62 is not old anymore. It used to be older. It's not even that old anymore. That's like the new 42. My point is, if you're 62 right now, you have a 50-50 chance one of you is going to live to 94. So when you talk about tax-free cash flow, let's also talk about a guaranteed income that you could have as well, almost like an annuity, but more like what we would call a term payment. You can build those in so they receive a certain X amount of money the rest of their lives. So you're talking about creating long-term sustainable income. There's a lot of different options here, but any questions specifically that anybody has about reverse mortgages? Does anybody have any negative opinions of reverse mortgages? I'd love to talk about that out loud.
I certainly don't have a negative opinion. A lot of the people that we meet, not all the people, but a lot of the people that we meet are in their mid-60s. And you're right, people are finding that they're healthier than their parents were, and certainly their grandparents. They're a lot more active.
Yes.
But what's the typical or prototypical good prospect for considering something like this? I mean, are there age limits? Are there house value limits? Things like that, or mortgage amounts? What is a good prospect?
Gotcha. Perfect. We really have three different types of prospects, right? We've got the constrained. Okay, this is grandma and grandpa. They own their home. right? And grandpa passes away and she loses his pension and a significant piece of his social security, right? We know that she'll take the higher amount, but oftentimes she's house rich and cash poor. And so a lot of our clients, or a significant piece of them, are trying to be more active, spend time with the family, but they own their home and they just don't have the cash flow for it. So being able to open up just a little bit of wiggle room, sometimes it's shutting off a small mortgage payment, but sometimes it's just a couple $100 a month that allows them to, continue picking up Susie Q from Highlands Ranch on Thursdays and taking her to dance. And what we've discovered is, just as you guys know, the dollars and cents, it doesn't lie, but it's about quality of life. That's what this whole game is about. And so how do we do that intelligently? By keeping the eye on that prize. I think that's one of the things our team's gifted to do. I would say the second most common client that we have is the constrained. Like, they've done well, they've set up for retirement. They've worked with somebody like any of you. They've put themselves in a strong position, but we know that inflation, that's a huge erosion of an overall portfolio, right? And so that is hitting them hard right now. So we're talking about just a little bit of wiggle room, whether it's turning off the mortgage payment or if their home's paid off. It's just set up that standby line of credit, pull anywhere from 30 to 45 or 43%-ish, put it into the line of credit and just let it sit there. A lot of people don't know it's required by law to grow at a percentage above the negative amortization. So that's a great tax-free bucket to set up, and it's there to draw as an asset there to hedge against inflation, whatnot. And then the next one are the comfortable. All right, we've got products that go up to $10 million. And if you are working with clients with that type of portfolio, I would give two scenarios that come to mind right away. I had a colleague who had a client out of Northern California. I think he was rehabbing a hotel or something like that, but he got hit with a $7.2 million capital gains bill. All right. Ooh. So he called up my colleague and said, hey, I've got a $10 million home. It's my primary residence. I do live there. Can I pull that money out? And I can't remember how old he was, but he was a little older. And essentially they ran the numbers. He said, no, you can't pull 7.2 out, but we could pull about 4.5 million out. So he paid the IRS 4.5 million. He set up a payment plan for the difference, right? And this gentleman's only other option, his only other option would have been to pull almost $15 million out of his qualified account, Northern California, to net the 7.2-ish. That was his only other option. So that's one example of how a high net worth individual might utilize this. All right. One other example comes to mind: high net worth C-suite executive, food distributor or something. I can't remember, but he had like a $4.5 million home, if I believe. His note servicing each month, or his mortgage payment, was like 22 grand. His portfolio was set up and doing well. In fact, they were expanding it. The estate plan, or the estate plan, called for $15,000 a month life insurance premiums for the next decade. All right. And while looking through his assets, trying not to be tied down too much, he was able to discover he could simply shut off his mortgage payment. He still owed about $2.5 million in the home. So he just simply shut off his mortgage payment of $22.5, something like that. And that's how he cash flowed for that, to fulfill that estate plan. So we work with grandma and grandpa that's struggling all the way up to higher net worth individuals that are making money work for them. So those would be the three different examples, I'd say. And on this note, this is a message that we are genuinely trying to share with everyone, is that everybody knows someone. Everybody knows someone that needs to know about this product. Whether it's at church or even within your own family. You'd be surprised how many people are all put together and they've got the home and the house and everything, but they're tight. And if they knew about this, they would want to know more about it immediately, but they just don't know. And maybe they're it still has a little stigma to it. Mm-hmm. But we also know a lot of higher net worth individuals. And if 5 years from now, if your colleagues and yourself, if you guys don't understand how to wield this product, the models are coming out and showing a tremendous amount of impact. There's going to be fiduciary responsibility to understand this. Mm-hmm. And so my humble advice, it's kind of always free, take it or leave it, but you guys are ahead of the curve. We're trying to get this message out, and I'm proud to be here answering some questions on this.
Yeah, we appreciate it, Brian.
Yeah.
Veronica?
Hey, how's everybody doing?
Good.
I just have a question for the people that are just getting into the retirement part. Would you recommend suggesting like for them to do it as they're getting ready to retire versus waiting until money is tight and now the struggle's here?
Gotcha. Well, like I said, FINRA has changed their position in 2017 on it. They haven't specifically advised any strategies how to use it or when, and there's still some people a little uncomfortable with it. But the reality is, and this information is what's going to be coming out, is at age 62 is the earliest you qualify for the FHA product, age 62, okay? And for people that either own their home outright or have a significant amount of equity, the long-term blueprint to maximize this from a tax-free perspective is turn it on as soon as possible. And here's why. The line of credit growth, the compounding year over year, okay, with the strategic timing of mortgage payments, if comfortable, okay? So essentially, if their home's paid off, but they don't mind making a mortgage payment, that's not a big deal to them. They need to set up as much as they can in the growing line of credit and just let it set. If they want to make the mortgage payment, great, that's going to have an even bigger compounding benefit. But if they don't, that's okay too. So to answer your question, from a strategic standpoint, the earlier, the better, at least. Want to wait a little bit, but when you start talk about delaying Social Security and the compounding benefit of almost 38-40%, if they're able to wait, a little bit of cash flow from a reverse mortgage. So to answer your question, this should be looked at age 62 immediately, but that doesn't necessarily mean it should be executed at 62. We need to look at everything else as well.
Perfect. Thank you so much.
Yes, ma'am.
So I have a question. Can you hear me?
Yes, ma'am.
Okay. So if we identify someone, a colleague, a client, whatever, how would we get them? Like you said, there's no way we're going to be able to do justice to, the information that you've told us. What would our next step be to getting them the information that they needed?
So one of two things are working really well for us, both with our advisors and wealth managers, as well as our real estate partner. It is impossible to have this conversation. You even say the word reverse mortgage, and you're probably already in trouble, right? And so that's the reality of it. Some people are a little bit more into it than others, and some people have some stigmas to it. So our advice is simple. Start with the benefit and not the features, right? Very elementary, but it's very simple. As an advisor, I would say, listen, as I look at your portfolio, if they're still carrying a mortgage, all right, a mortgage payment into retirement, okay, then I would have the conversation, which 83% of seniors are carrying a mortgage payment into retirement. I would simply ask them if that mortgage payment was voluntary, would that be a benefit to you? And they might give you a kind of interesting look, but you'd be surprised. They would say, and you're going to know the answer, obviously, as their advisor, but walking out just the benefit of the mortgage payment and not having that. Let's just start there. Let alone having a larger conversation about the credit line. That's something to unpack maybe a little further. But if you can ask them that question, all right, and ask them if they are willing to sit down and have a conversation, or we can send them some links about how this works. Either way, we make it very easy for you to just ask that question and then put them in front of either us or a couple of pieces of information. Chances are they either do one of two things. They either call you back in a day or two, right? And they're like, how does this work? Let's unpack this, right? Their curiosity's piqued. Or they might just, have started their journey where it takes a little bit of time. So you're hitting it on the head. Don't be the expert. You can't be. I'm not saying avoid the word reverse mortgage. I would talk more about the benefits of having a tax-free line of credit that you could draw upon at any time. All right. That can never be revoked or taken away or reduced. All right. I would talk about the benefits of how long they're least know. If they're going to be less than 3 years, I would suggest knowing about a reverse for purchase, just so they have that tucked away, whether it's their dream home or their second home. They should know that. But they shouldn't do this if they're staying less than 3 years. But if they're staying more than 3 years, they've still got a mortgage payment. I would ask about that mortgage payment. If they don't have a mortgage payment, then listen, this is just time to talk about tax-free cash flow. And that's the most fun conversation to have.
Yeah.
Bring us in, we come in and meet and have coffee. This is a face-to-face type of deal. So often we get to know you quite a bit more before that becomes really comfortable to just kind of lay up like that. But we're always available. Holly, my wife, as well as the rest of our team, we are just popping on the phone constantly, either answering quick 5-minute questions oftentimes, or doing a 3-way with a client on the phone. But we're here to serve. Everybody absorbs a little different. But I wouldn't jump into trying to explain it. I would just ask for the benefit to see if it's there, and then set up a time to bring in one of your expert partners so that you guys can facilitate that. That's my advice.
And do you just work local to Colorado, or are you can you work nationwide?
We can work nationwide. We are backed by a bank, as well as, so we're a broker. We have 9 different lenders we partner with, and we're also backed by a bank. So we're on all 50 states. If you got people moving from California here, this is a no-brainer. They could sell that home and put 60% down on something out here, keep the rest in their pocket, no mortgage payment. I would say 10%, maybe a little more, of our clients are coming here from California. So other clients are actually coming here from like Kansas or Missouri because their kids have moved here, right? And they got grandkids out here, right? And they're not leaving Colorado, right? And so they call us, one of our real estate agents up, and they're like, hey, I got $300,000. You sold my kids a place out there. I'm moving out there. Well, what can you get for $300,000 out here?
Nothing.
Right. And so they fire that real estate agent and they hire
You
one.
can get a tiny house with an extension.
Yeah.
That's
Right.
it.
But when they fire that real estate agent and they either talk to an advisor like you that's met us, or they've been to one of my CE classes as a real estate agent, and they discovered they can get into something for about 600 out here for that same 300,000, that's a game changer. So you climb up the ladder, or you keep more money in your pocket. Depends which coast you're coming from, I guess, or at least which direction.
Yeah.
Good stuff, Brian.
Yeah.
This has really been helpful, and I think it's been an eye opener, certainly for
Yeah.
me in a couple of areas. The opportunity to purchase property with a HECM makes a lot of sense. Having some rough guidelines as to who it's a fit for, and the age thing obviously is very important. This isn't something for our younger clients. So if Denise or Lisa or Veronica have somebody that they think is a prospect, what's the best way for them to get in touch with you?
Yeah, I would say to reach out, and I would write this down. My wife handles all of our VIP clients. We do other ways of advertising, obviously, but when we're working with VIPs like this, she prefers to handle them. So it would be Holly at bingorm.com. Holly, HOLLY, at bingorm.com, or just go to bingoreversemortgage.com. Ask for me or Holly.
And I will forward, I'm going to forward Holly's contact information on to those of you that are on the call today.
Okay.
So that you guys have it.
Fantastic.
What else? Who else has got a question before we go dive back into the Medicare pool?
That's it about me. I didn't know. I was like you, Dave. I didn't really know about the purchasing part. I've heard about them on television with Tom Selleck advertising them, and but I didn't really understand. I didn't know about the purchase option or that part.
Yeah,
that's pretty cool.
Do you guys have a superstar associated with Bingo? I mean, I don't think we'll be meeting with Tom.
That would be my wife.
Your wife, okay, Holly,
That would
yeah.
be my wife. Yeah, I have
Yeah,
more of the
okay.
face for radio. So yeah, I mean, you've met her, you know that.
Yeah.
You know, the last thing I kind of leave you there with, I do offer continuing education class. Now it's for real estate agents right now, but it's on our website. I'm telling you, every financial advisor, every wealth manager that I've had come through that have said this has been the best, like simplified overview of all the ways to use this product I've ever seen. So I'd invite you to look. I'd love to see you in there. Please point me out if you come in that you're not a real estate agent, so I can up my ante. You guys are a little further up the chain of command, if you know what I mean. So,
Yeah.
but it'll be fun. You guys will enjoy it. It's a pleasure speaking with all of you.
Thank you.
We
Thank you.
appreciate the investment of your time. I'm sure that in our travels, we will come across people that I'm kind of left with the idea that does the conversation make sense? I don't know whether the product is a fit or not, but does the conversation make sense? And I would encourage you guys to look at it that way. And then if so, we'll get them engaged with you. And once again, I appreciate the time of our agents during this busy season. Brian, I appreciate you and Holly taking the time to kind of fill us in how this works. And we'll look forward to maybe kicking up some dust here in the near future.
Be my honor to serve you. Thank you.
All right, you guys. Everybody take care.
Thank you.